Hello students, I am Priya Saxena and I will be taking your unit number 2 of Management of Financial Services. Management of Financial Services unit 2 consists of these 4 topics. As these 4 topics are really big, the last 2 topics I will be covering in the next video. So let's start with Management of Risk in Financial Services. Now, what is risk? Risk is any danger that is happening to us. It could be in the form of money, in the form of property, wealth, health, product, anything. So any danger, any bad happening to us is a risk. Now risk is subjected to exposure. Exposure means if we are open for any kind of risk, if we take risk, then only the loss will be happening. If we do not take any kind of risk, the loss will not be there. So let's start with the definition of risk. Risk refers to the probability of loss, while exposure is the possibility of loss. That means any kind of loss is referred to as risk, and exposure or opening towards the risk is known as the exposure. Since we are studying this financial services, in financial services, the loss of expected return, or we can say the money earned or the funds we are about to earn, is the simple loss in form of funds, in form of money. Any sort of loss in form of money is the risk of financial services. So it gives you 2 characteristics of risk. That means uncertainty and loss. What is uncertainty now? Uncertainty is unpredictability. Unpredictability means if we are opting for any kind of risk, we are unpredictable. That means it is unpredictable whether this risk will result in some kind of loss or we will be in any kind of profit. So that is why it is uncertain. We cannot say firmly that this investment will lead me to some sort of loss. Then second is loss. Since risk is a negative term, see, I have already mentioned it is danger. It is kind of loss. So risk, if you are opting for risk, that means you are ready to opt for any kind of loss, which is the consequences of your investment. So if there is a risk, there is an uncertainty, and obviously there will be loss associated with the investment. So looking at the fact, looking at the thing that is risk, we can find out what are the things that would gives us the risk. We can identify them and we can reduce the risk which is in our investment. So identifying the process of identifying the values or the things which are factors which are giving me risk, accessing them and controlling them on our own is known as risk management. So risk management is the process of identifying, assessing and controlling threats to the organization. Whatever risk comes to the organization, controlling them and identifying them is the risk. Now, let's proceed to the type of risk in finance. What are the type of risk in finance? See, there are 2 types of risk. One is the systematic risk. Other one is the unsystematic risk. To understand this, systematic risk is the external factors and unsystematic risk is the internal factors. It is already mentioned here, that is, it is macro in nature and it is micro in nature. So first we will see the systematic risk. See, systematic risk is any risk which is arising out of the system. It is applying everybody as same. It has no differentiation between one organization or the other organization. So systematic risk is when risk is a part of system and it is uncontrollable. Like demonetization, it was applied to all. It was not like that कि एक firm पे हुआ और एक firm पे नहीं हुआ. So systematic risk is the thing which is a part of system and applicable to all. That is why it is known as macro in nature or the external factors impacting. We'll proceed to the types of the systematic risk. The first one is interest rate risk. Interest rate risk, as the name suggests, interest rate risk means any risk which is arising because of the change or variability in the interest rate. Interest rate in form of return, interest rate in the form of dividends, EPS, whatever. So interest rate risk is arising because of the variability and change in the interest rates. The first one here is the price risk. Now, what is price risk? Price risk is the change in the price of shares. If you have invested in shares and there is a change in price, like if you have purchased any share of 100 rupees and now it comes to 30 rupees or 40 rupees or 50 rupees, this is loss of money. You have not earned anything. You have invested there because you might have thought that it would result in the income. मतलब 100 रुपए का जो शेयर है वो 150 का हो जाएगा, but in spite of that वो कम हो गया. So this price risk is simply the change in price of shares. Now the second one is reinvestment rate risk. See, reinvestment is when you are reinvesting any kind of money already earned. So reinvestment risk says that whatever interest, whatever income you have earned from a single investment, you cannot reinvest that money with the same rate of return. Supposedly I have invested in preference share and they are giving me an interest rate of 8%. It is not at all necessary that whatever I have earned at the rate of 8%, I can reinvest that money at 8%. It could be 8.1, 8.2, 8.3, or it could be 6, 7, 6.5. It is not at all sure that you will be getting the same rate of interest again which you have invested priorly. So to sum up, reinvestment risk is interest earned from investment can't be reinvested with the same rate of return. I guess I'm clear. Now moving to the next one is the market risk. As the name itself suggests, market risk means any risk which is associated with the fluctuations of the market. Here fluctuations of the market refers to the fluctuations of stock market. So anything which is related to fluctuation of stock market is market risk. Moving to the first one, it is absolute risk. Now what is absolute? Absolute means is also known as probability risk. Absolute risk is also known as probability risk. Absolute risk is a chance of an event to happen. That means if the event is happening, then only I will be exposed to such kind of absolute risk. If there is no probability of loss, there is no probability of the event to happen, then definitely I am not going to get the loss. I am always going to get the profit. So absolute risk is when chance of an event to happen. Now moving to next is the relative risk. Now what is relative risk? Relative risk is, what do you mean by the term relative? Relative means in comparison to some other factors. So relative risk is when we compare our risk to some different group or different factor, it is known as relative risk. Suppose if there is a rise in price or there is a rise in the interest rate, there is a rise in the demand of the price share. Obviously, share prices increase as the demand of the share increases. So this is what relative risk is. When you compare one factor with the other one, it is known as the relative risk. Moving to the next one is the directional risk. Directional risk is in relation to market or in accordance with the market. That means supposedly my market is going bull. My market has the condition of bull market. Then the prices will rise. I'll be earning better. And I say the market is bear. The prices are going down, the market is going down, and in line with that, in accordance with that, my risk is also getting, my loss is also getting higher. So this is what directional risk is. When your risk is according to the market, it is going in direction with the market, that is known as the directional risk. Now if we talk about non-directional risk, see what non-directional risk will be. Obviously not in accordance with the market. That means if I found that market is bear or market is bull, but still the prices of some of the shares are getting down. Markets are bull, but the prices of many shares are decreasing. That means there is somebody who is speculating about the price of the share. So non-directional risk is when the speculation in the market cause your risk or cause your price to move opposite to the direction of the market. That means जब bull होगा तो वो bear करने की कोशिश करेगा, bear होगा तो वो bull करने की कोशिश करेगा. It is opposite. That means it is not in the direction of market. Somebody is doing speculation in the market. So this is what non-directional risk is. Moving to the next is the basic risk. Now what is basic risk? Basic risk is, this is the bare minimum risk which one can take, and it can be offset with any of the things. That means risk which is going to offset. Suppose I have a loss of rupees 50 from one share, and I am going to offset that loss by earning 50 or 100 rupees in some other share. That means whatever loss, whatever risk I am bearing, I am basically reviving it from the market. जितना घाटा किया उतना कमा भी लिया. So we have offset our risk, we have offset our loss. So that is what basic risk is, the bare minimum risk which is there and we can handle it. क्योंकि जितना हमने लॉस कर रहे हैं उतना ही हम कमा ले रहे हैं, तो हम उसको बहुत ही ईजिली हैंडल कर सकते हैं. सो दिस इज व्हाट द बेसिक रिस्क इज. नाउ द नेक्स्ट इज द volatility risk. Now what do you mean by volatile? Volatile means the market is moving, it is changing itself. So there is some kind of face value, there is some kind of start price or the price from where you have started your investment. So volatility risk means whatever change or dispersion is in the price with relation to market. That means how volatile the market is, the change in percentage, the dispersion. That means 100 पे खरीदा था 110 पे पहुंच गया है, so dispersion is 10% or the volatility is 10%. So it is always calculated in percentage. So volatility risk is what? When your market disperse or change, that is the volatile market or volatility risk in the market, which is measured in terms of risk. Now coming to the third one, which is purchasing power, or we can call it inflationary risk. Why it is same? Purchasing power means whatever item or whatever product I can purchase with given amount. So that is what inflation is. We have studied this in economics. So inflation means for the fixed amount of money, how much I can purchase a product. So it decrease our purchasing power basically. So purchasing power जब decrease होती है तभी inflation बढ़ता है. So that is why it is known as purchasing power or inflation risk. Here we have two different kind of risk. One, is the demand inflation risk, another one is the cost inflation risk. Now, what do you mean by demand inflation risk? See, demand inflation risk means when the demand is high. It is simple law of demand. When the prices are high, when the demand is at higher end, the prices will increase. Fine. When demand is at the higher end, prices will definitely increase. And if prices will increase, what will happen? Inflation will increase. And when inflation will increase, obviously the purchasing power of the individual will decrease. Purchasing power means the availability of money to buy a product. Correct? So if demand increase, then price increase. Price increase होगा तो inflation increase होगा. And if inflation increases, it also increases the purchasing power. It decreases the purchasing power of individual. So purchasing power risk is the demand inflation. Demand inflation क्यों बोला? Because demand is the only factor which has resulted in such kind of inflation. Demand बढ़ा इसीलिए ही inflation बढ़ गया. That is why it is known as demand inflation risk. Now, moving to next one, cost inflation risk. Cost inflation risk is what? The manufacturing cost of the product increases. That means जो भी product में हम material लगा रहे हैं, the price of each and every material increases. When the price of each and every material increases, it results in the increase in price. क्योंकि जितना मैन्युफैक्चरिंग में पैसा लगाया है वो तो निकालना ही है. So for the cost of manufacturing, we put the selling price at the higher end. Selling price higher end होगी तो obviously purchasing power decrease हो जाएगी हमारी. Correct? So that is why it is cost inflation risk. Cost is the only factor which is impacting the purchasing power of the individual. Cost has increased the price of the product and hence the purchasing power. So that's all for systematic risk. Now moving towards the unsystematic risk. Unsystematic risk, I have told you, unsystematic risk is not a part of system. It is not arised out of the system. It is a risk which is the managerial inefficiency of our own organization. कुछ ना कुछ operational loopholes रहे होंगे जिसके कारण unsystematic risk आ गया. और ये this is different for every firm. It is not similar for firm. It differs from firm to firm. So let's start with the business risk or the liquidity risk. See, liquidity risk is cash, availability of cash. Obviously, liquidity is availability of ready cash or the readily available current assets which can gives us cash. So liquidity or business risk is that. Because if we are out of cash, we are having inadequate cash, then not only the production processes stops, but also we cannot purchase things, we cannot give it to our creditors and all. So inadequate cash is, in any case, it is going to stop the production process. Or because we are reading financial services, obviously if we do not have cash, we cannot do the settlements of the investment. Maturity आ गई लेकिन हमने सर्विसेज का सेटलमेंट ही नहीं किया बिकॉज कैश नहीं है फर्म के पास. So this is what liquidity risk is. Now here we have two sort of risk. One is the asset liquidity risk, other is the funding liquidity risk. Asset liquidity risk क्या होगी? This is the inability to sell or pledge a product for cash requirement. That means we do not have any liquid asset. We do not have any current asset which can be converted into ready cash. That means we are out of cash because we are not having any sort of current assets with us. So this is what asset liquidity risk is. We don't have any current assets. Similarly, funding Liquidity risk is what? Not having an excess or even sufficient fund to make a payment. We cannot make payments. We do not have funds to make payments, to do settlements. This is what funding risk is. We do not have fund for the settlement processes. Fine. Now, moving to the next is the financial risk or the credit risk. Now, tell me, what is financial and the credit risk? Credit risk means कितना उधार लिया पैसा मैं चुका नहीं पा रही हूँ, है ना? That is financial risk. मतलब for repaying something I have no cash, and because of that my financial burden, the financial burden in the firm is increasing. So this is what financial risk is. Here the first one is exposure rate risk. Inadequate financial risk or credit risk. Inadequate to meet the financial obligation. Now here exposure risk is what? Because of the change in exchange rates. Exposure is basically exchange rates में जो difference आता है, the currency वाला, ठीक है? So exposure rate is risk arises because of the change in exchange rates in the market. मार्केट में exchange rates बदल गए हैं जिसकी वजह से मेरे को exposure risk है. Then the recovery rate risk. The recovery rate risk मतलब recovery rate should be always expected. Recovery rate should be always be the expected recovery fund. Expected recovery fund means whatever return I am getting out of a loan, suppose, the recovery rate should be within that. Means whatever I am investing on that, it should also be recovered. So recovery rate risk is to recover any kind of loan, I have to bear some sort of losses. So this recovery rate should always be expected recovery fund. Now the credit event risk. Credit event risk means it is simple. Whatever credit I am giving to anyone, I can also give credit to my so-called debtors, so-called creditors. So whatever credit event risk is, that means जिसको मैंने पैसा दिया है वो return ही ना करे. Correct? Malia types. Whatever credit I am giving to any of the client, he is not going to repay it. This is what the credit event risk is. Whatever credit I have given, I am not going to get it back. Again, the sovereign risk. Sovereign risk is what? Sovereign risk is sovereign, related to government, है ना? When government is unable to meet its loan obligation, when it is unable to meet its loan obligation, it is unable to give the money back. This is known as the sovereign risk. Now the settlement risk. Settlement risk क्या है? When counterparty does not deliver. That means whatever we have an agreement of, see, all these financial service, we have a sort of agreement with the people. The counterparty means the opposite people is not delivering according to the this agreement, then this is known as the settlement risk. They are not settling the funds, they are not doing the settlement of the financial service. Now coming to the operational risk. Operational risk is very easy, you know. Risk arising from the operations. That means through the business process, whatever risk is arising, that is known as the operational risk. Here the first one is the model risk. Model risk means simply various models are used to value financial services. So whatever model I have used, it could be different for different firms. So this is what model risk is. It is not at all necessary that valuation of services, the valuation of stocks, whatever model I am using, it is not necessary that the counterparty or the different firms are using the same model. So when the model of operation, the models of valuation of stock is different, it is known as the model risk. Then again, the people risk. What is people risk now? People risk is when people does not follow rules and regulations or the process of the organization, then it is known as the people risk. Here people risk means we have some process of doing all these things. We are having a process of filling the form, we are having a process of the interest rate discussion and all, the returns discussion and all. When it is human error, when people are not following the procedures of the organization, then it is known as the people risk. Moving ahead, legal risk. Now legal risk is obviously related to law or related to compliances. When we are not meeting the compliances, we are not meeting the legal obligations which are on us, that is known as legal risk. We have to manage some sort of compliances also. अगर मैं इंश्योरेंस सेक्टर में हूँ तो मेरे को IRDA के सारे compliances fulfill करके रखने ही हैं. If not, then I'll be into penal act. So that is why law related जो भी risk है और compliances related जो भी risk है, that comes under legal risk. Now the next one is political risk. Obviously change in the government policy. If there is any change in the political government policies, it is applying to all, but if there is any change in the government policy, then the political risk arises. Fine. So I guess I'm done with this type of risks we are having. Now moving ahead towards the risk management. I have told you in the first part itself that when we know that these are the kinds of risk and these are the factors which are giving me risk, which are impacting for the risk, then we can manage these risks through one or the other way. So for the first one, risk management framework, look into the first we need to see establishing risk management and group and set goals. What are the factors of risk management a firm is following? Then here comes the next one, that is identify the risk areas. What are the areas which is giving me any kind of risk? So this is risk areas. Then understand and access scale of risk. Scale of risk means what is the measurement of risk, what is the impact of it, how it is going to impact me. मेरे को बहुत ज़्यादा लॉस हो रहा है या कम लॉस हो रहा है, कम रिस्क है, ज़्यादा रिस्क है. This is all is the scale of risk. Then once we finalize the key factors and the scale, we can find out the risk response strategy. Means अब मेरे को रिस्क क्या है, कितनी है, ये पता पड़ गया. अब मैं इसको किस तरीके से रिस्पॉन्स करूँगी. दिस इज व्हाट माय रिस्क रिस्पॉन्स strategy is. Now moving ahead, develop a risk response, implement strategy and allocate responsibility. Now we have finalized what strategy we are moving with, then we need to allocate the responsibility with the employees. Next is implementation and monitoring. सिर्फ allocate करना important नहीं है, we have to implement it, then we have to do the follow-ups with the, or we have to do the monitoring whether the things are going in right direction or not. Moving ahead, review and refine the process. That means once we have done with this, we need to review whether whatever option we have done. It was okay. The risk has, whether the risk is being decreased or not. If it is decreased, then it is well and good. Otherwise, some more refinery processes are needed, then we can refine it and again jot it down. So this is what risk management framework is. So here I have written, see, based on these cycle, you can find out that we are having only 4 basic things for the financial risk management. First is the risk identification, कैसे identify करेंगे, development of risk response, implementation and review. Fine. So we'll go one by one. See, this is risk identification and assessment. Risk identification and assessment means to find out what the risk is, and assessment means now अब मैं scale पता कर रही हूँ. What is the scale of this risk? See, on the x-axis I am having the impact. कितना loss मुझे होगा. This is what the impact is. Low, medium or the high. On the y-axis it is likelihood. क्या probability है? What is the probability of happening of that risk? What is the probability of that risk? So this is likelihood. How much you are confirmed that this loss will be going to happen. So again this I have decided to low, medium and high. So here what important is, according to likelihood, if the loss is low, likelihood is high but loss is low, then you can surpass it. Okay, ठीक है. But if the impact is high, we don't have to follow the likelihood one. We have to follow the impact one. How much the risk is impacting on us. So if you can see the 4th circle. What is it saying? That the impact is the highest. Impact इसमें सबसे ज़्यादा है, although likelihood is the lowest one. But since the impact is on the higher side, I am not going to do nothing about it. I have to make strategy for this high impact thing. So likelihood impact matrix gives you, it is not possible for the firm to work on each and every risk. So it provides you a matrix of likelihood and impact. We need to cover up those risks or decrease those risks whose impact are on the higher end. Now, these are the risk response. Risk response means now you have found out कि भाई ये risk है, and these are the impact I will be facing. Once you have jot down that, you have to make strategies. You have to make strategies for the same. So risk strategies and tools again can be divided into 3 things. The internal strategies. Internal strategies means strategies your firm is applying on themselves on the basis of operations. Operations में कुछ फेर बदल करके हम इस रिस्क को कम कर सकते हैं. So this is what internal strategies are. For this they have given 2 sort of tools. One is the natural hedging, other one is the internal netting. Hedging, I guess you people understand. Hedging means to limit the loss. To limit the loss. Here what we do, we will apply a hedge. Natural hedging will be done. We will apply a hedge. We will limit the loss. As soon as the loss is at this point, I will withdraw the investment. This is what natural hedging is, to put some sort of limit on this. Then let's proceed to the internal netting. Internal netting in general terms means, now moving to internal netting. Internal netting is basically to reduce this risk, we need to do settlements between 2 or more parties. So when we are settling in between the parties, we are basically netting it to reduce the risk. Now risk sharing strategies means we are sharing our risk with with one or the other options. Like we have the derivatives given here. See, forwards, futures, we can do a joint ventures, we can do swaps. Forward, future, swaps all belong to derivative market and they are the future deals. Then one is the risk transfer strategy. Risk transfer strategy in the sense we need to transfer it. We are transferring our risk on the basis of whatever we are having for getting the benefit. So there we have insurance, there we have securitization, there we have option. Option means for future dates we are having the option that okay, there is a loss, जो मैंने purchase की थी डील, जो मैंने ली थी डील, उसकी purchasing price अब कम हो गई है, तो I have the option to deny the deal. Insurance means ensuring that risk, that whatever loss I'll be having, it is insured. Securitization means one by one or the other way we are securitizing the investment, whatever investment we have done. Moving ahead, these are the risk measurement tools. See, for the exam purpose, this is only no numericals will be there, so only for the exam purpose I'm giving you this. What are the risk measurement tools? The statistical tools which are used for the risk measurement is first the range. I guess range you people understand, the upper and the lower limits of a investment. These are the range. कितने रेंज में रिस्क है? वेरिएंस एंड स्टैंडर्ड डेविएशन. अगेन हाउ मच वेरिएबल डिफर्स फ्रॉम इट्स एक्सपेक्टेड वैल्यू, और हाउ मच the member of a group or the investment differs from the mean value. This is variance or standard deviation. Coefficient of variance is the ratio of standard deviation to the mean. Then regression I have already written. We used to keep one thing fixed, one variable is fixed and it is getting affected by some other. That means prices. Price, you can say price and interest rates. These are impacting each other. So regression is when we see the impact of one variable to another. That is regression analysis. Then value at risk analysis. Value at risk is also known as VAR analysis. Value at risk analysis is the maximum likely loss on a portfolio. That means ये maximum loss है which I will be bearing for holding this investment for a period, for a specified period. 6 महीने के लिए अगर मैंने कुछ इन्वेस्टमेंट किया है तो इसमें मैक्सिमम इतना लॉस होगा, इससे ज़्यादा नहीं होगा. Then scenario analysis. Scenario analysis is more of qualitative test which we do. This is qualitative tools which is what if kind of things. What if ऐसा हो गया, क्या होगा अगर ऐसा हो गया. So these are the also sometimes referred to as stress test, sensitivity test or what if analysis. So here we are done with the risk measurement tools and the risk in financial services as well. Now we will proceed to the concept of merchant banking. Now, what is the concept of merchant banking or who is merchant banker? Merchant banker is nothing but an institution or a high net worth individual who do wide range of activities for the business firms. They are not the one who gives the banking services or the non-banking services. They gives a huge or a whole lot of services to the business firms. We will go with the definition. Merchant banking may be defined as institution which covers a wide range of activities such as underwriting of shares, portfolio management, project counseling, insurance, etc. Underwriting of shares means if a firm wants they want to subscribe or they want to put their shares for the public, then this merchant banker usually give the decision that whatever amount is unsubscribed, जितना लोग नहीं लेंगे, that amount I'll be taking for you. That means he is taking care of all the capital I am needing. So underwriting of shares he used to do. Portfolio management, that means diversifying your portfolio. You must have different sort of investment alternatives into it. So this is what portfolio management is. Project counseling, when you are opting for some or the other project and he is doing the counseling. And insurance and etc. So for all these things he charge a fee, and that is what he is earning through that. So both commercial and investment banks may be engaged in the merchant banking activities. Now, who is a merchant banker? Merchant banker is critically a link between a company raising fund and the investor. Pehla, which was underwriting services. Correct? So this is what he is bridging a gap for a company in raising fund from the public. Next one is underwrites corporate securities and advises on issues. He is doing the advisory services here. He is giving counseling, he is giving consultation to big corporates and all. The merchant banker may be in the form of a bank, a company, firm, or even a proprietary concern. Merchant banker understands the requirement of the business concern and arrange finance with the help of financial institution, बैंक, स्टॉक एक्सचेंज एंड मनी मार्केट्स. ये सारी चीज़ें वो करके देता है. नाउ few service providers I have mentioned here, like Grindlays Bank, Citibank, Standard Chartered Bank, Hong Kong Bank. These are all the merchant banking banks. Now if we continue to Indian banks, it is SBI Capital Limited, established by SBI. If we proceed to financial institution, it is IFC and IDBI, Industrial Development Bank of India. Then if we proceed to private merchants, they are Karvi Investor Services. They do all these aforesaid things of merchant banking for a company. J. Morgan Stanley Limited, DSP Merrill Lynch, etc., etc. These are the few merchant banking providers. Now, whatever we have learned, this is same. Functions of the merchant banker: raising finance for clients, obviously share issue करते हैं. Brokers in stock exchange. Project management, they do project management services. Advice on the expansion and modernization. अगर कंपनी को expansion करना है और modernization करना है, they do advice for the same. Managing public issues of the company. If a company is going public, that means if it is raising capital through public, they help them. Handling government consent for industrial projects. They are the one who handle the compliances with government for the project. Special assistant to small companies and entrepreneurs. Service to public sector units. They also provide services to government units itself. Portfolio management, again diversifying your investment alternatives. Corporate restructuring the corporates. Money market operations, जो small और medium term money market instruments हैं, उनको deal करना. Leasing services, and last, management of interests and dividends. Apart from these all the things, they also manage how much interest we need to pay and how much dividend we need to pay. So these are the functions of merchant banker. Now, scope and services provided by merchant banker. What is the scope of service of merchant banker and services? Services, you can read it. It is all same as we have read. Underwriter, banker bhi hai, broker bhi hai. It is registrar, it is debenture trustee, portfolio manager. There are hell lot of services which merchant bankers provide to corporates. Fine, they are providing all these services to corporates. Here come the scope. Growth of new issue market. Obviously, if I am having any kind of assurance of somebody or some financial institution, then I'll be going public very often. मैं अपनी कंपनी को पब्लिक लिमिटेड बनाने में इंटरेस्टेड रहूँगी because it increases the growth of new issue market. Then entry of the financial institutions, है ना, investment institutions. तो यहाँ पे क्या है, FIIs को they give entries. Changing policy of foreign investment, because they are doing all these services cross borders also, so they have all the policies related to foreign investment. Development of debt market as well. Development of debt market in the sense the debentures, the loan market and all, this is also there. Innovations in financial instruments. Some new innovations they can bring. They can bring some new sort of instruments for investments. So there is a big scope for inventing some new financial instruments. So this is all with the scope and services provided. At the end, few of the points I have written. Corporate advisory services and all. These are again the services which merchant bankers are providing. So corporate advisory services cover the entire field of merchant banking, public issue, capital restructuring. Corporate को advise करना, corporate firms को advise करना are the corporate advisory services. Project advisory services, when they advise a corporate for a specified project, they are helping them with the compliance, they are helping them with the cost, the reports, the approval of the government and all. Then it is project advisory services. Credit or loan syndication. That means, this I have explained in the very first unit. That means when there is a need of huge amount of capital, they are the one to syndicate the loan from different banks. So this is what loan syndications. Management of capital issue. Obviously, if you are going public, if you are issuing your shares, then merchant bankers are the one who manage your preference debentures and equity shareholders. Underwriting is again guarantee which a merchant banker gives that whatever unsubscribed capital remain, I'll be going to take it. I'll be going to provide you with the amount of the money which is left unsubscribed. And then the portfolio management. Portfolio management is for minimizing the risk. Obviously, we are differentiating our portfolio. We are having variations in our investment alternatives. Why we do so? So that we can diversify the risk. Few are the factors which are giving me maximum returns. Few are the factors which are minimizing the risk. So it is a win-win situation to a portfolio management. So these are the few services I have explained in different. So that's all for unit number 2. We will be covering the stock operations and mutual funds in the next part of this unit. Thank you so much, students. Stay home, stay safe.